Thank you, Mr. Chairman. I appreciate the opportunity to discuss with you this afternoon something that I think is very important with regards to our small business folks and being able to access to capital. As a former regulator myself, a former bank examiner, I see a heads turn when I said that. That's interesting. I understand what you're talking about, I think, and I have some concerns from the standpoint that it's nice to see that you finally acknowledged that we have a huge disconnect what's going on here in D.C. with what's actually been going on out in the field. Because I brought this matter to the attention of all three regulators last spring and asked for a meeting with all three, Comptroller, Fed, and FDIC, and FDIC was the only one who accepted my invitation to come to our office and discuss this matter with our entire banking organization, Missouri Bankers Association. I thank you, Mr. Grunberg, for showing up. The other ones didn't take advantage of that. I'm very disappointed from the standpoint that Congressman Royce made a very good point a while ago and was pretty articulate about explaining the problem that we have, which is going on still yet today. And that is that the examiners are coming in with little or no forbearance and taking a look at the thing we're talking about today, which is commercial real estate lending, and just blanket classifying everything there. And you guys know that if they're not on a watch list, you know what a watch list is, automatically you're going to have to include more capital, which means it takes money out of the profits. It has to be stuck away in loan loss reserves or in additional capital itself to be able to keep the bank afloat. This is devastating to the small businesses, which banks are, as well as small businesses that they lend to. And I think that it's very concerning to me. And Mr. Grunberg, if you would answer, please, how are we addressing this right now?
Well, Congressman, there's nothing we've spent more time on than trying to work with and communicate with our examiners in the field. I mean, it's not a perfect process. There are, we have a couple of thousand examiners to deal with, but I can tell you we have 85 field offices around the country, the FDIC does. Last week, we brought the supervisor of each of those offices to Washington for a week. We spent time working through with them all the directives and guidance that we have issued to our examiners, particularly in regard to CRE and commercial loans, directed them to exercise flexibility and judgment and, as best they can, assist in the workout of these loans. Now, you can't always get the result for the institution and the borrower that you would like, but to this issue about the disconnect between Washington and the field, that's something we always hear, and I guess I've been on the board now for almost 4 years. To a certain extent, it's in the water. I think there's always that's sort of part of the nature of having a large national operation. But I can tell you we have really made every effort to communicate and work on a regular basis to make clear to our examiners what they're supposed to be doing.
Well, I'm sure you're aware that, as an examiner myself, I know that you're very responsive to supervisors over you all the way up the line, from the standpoint that if you don't do a good job of examining this institution this time, and you miss a lot of stuff, it's a reflection on your ability to do your job. And right now, with the economy the way it is, going in the wrong direction, it's pretty easy to go in there and see what you anticipate happening rather than what's actually happening right now. And I think that's one of the problems is we're doing a lot of anticipating, which is very concerning to me from the standpoint that you have, and anecdotally, there's been a lot of this already discussed with regards to folks who are already doing a good job with regards to their business. They're hanging on, lifetime depositors or borrowers of the bank, and no problems in the past. Now, all of a sudden, they're in trouble because of collateral values. And to me, without a little forbearance and a little discretion on the part of the examiners, you exacerbate the problem from the standpoint that by going in and restricting the ability of these folks to lend, you cause less lending to happen, which causes less demand for the real estate, which lowers the price, which suddenly now the collateral value of everything goes down, and you've got a spiral to go in the wrong direction. And quite frankly, you guys are part of the problem. And it's very concerning to me that we don't have some sort of effort to try and work out a program. I hope that you guys are doing this. I'm concerned because I keep following up with my local institutions at home, and the examiners have still not really gotten to the point where they're actually working with the banks. So what in my judgment, is in the best interest of not just the banks, but the community and the whole economy as a whole here. So I'm very concerned. Ms. Mills, One of the statements you made a minute ago was with regards to the SBA's job is to make credit available elsewhere. One of the earlier witnesses.
Gentleman's time has expired, so if we can get a quick response, can you wrap this up to get a...
My question just simply was, one of the witnesses a while ago made the comment that they like direct lending from SBA, and obviously from your comment, you would rather have be guaranteeing the loans versus direct lending, and just your response.
Yes, our job is to make loans and loan guarantees when the market is not providing it. So therefore, there are a number of market gaps that are out there today. As I said earlier, we did assess direct lending. It ended up with a cost 15 times as much, and we'd have to train a new force. It's been suggested we use our disaster force, but our disaster force is actually not trained for business loans and is busy doing disasters. So we have looked at that option fairly closely, but believe that we've got a very strong infrastructure in our network of banks, and if we can increase our ability to do credit elsewhere, we can meet the gap.
Thank you, Mr. Chairman, for your
Gentlewoman.
forbearance.